Okay, welcome to another video. This one we're going to be going through the global risk radar. And I thought that this topic would be particularly interesting, especially given how the market and economies have been turning out this year, and certainly a big dose of headline risk. But what really is risk when it comes to investments, and how should we think about it? And that's what we're going to have a look at here. So we're going to initially get into just a quick bit on the, how my research process and how I think about risk, and you can consider that. And then we'll go and have a look at the global economic risk radar, some of the key sort of weak points or key standouts there, and then finish up with a look across asset classes, the major ones where I'm seeing risk and opportunity and across some of the major markets there. So we'll get straight into it. Just a quick bit about me. Callum Thomas, the founder and head of research at Top Down Charts. Started it up almost 2 years ago. Previously worked in the buy side, and the clients of Top Down Charts are usually in the hedge fund, pension company, wealth manager, investment consultant space. Reason for it being is to add a little bit of extra analytical muscle to what they're doing. And the focus is very much top down and macro driven. And speaking about the process or the focus, this is kind of just an overview of how we go about assessing risks and opportunities across the various asset classes and markets to look at. So typically start with the valuation view, or valuation as an anchor. And the good thing about doing that is that it can help prevent you from chasing your tail, and also gives you sort of an overall directional bias. So for example, if you coming from a position where markets are particularly cheap, that helps frame how you look at the rest of the various indicators, and how you round out the picture there. And then into the cycle. So once you've set the produce some sort of valuation picture, and you may need to use some sort of proxy for various other asset classes like commodities. We've got a couple of things we look at. For cycle, it's really about the macro cycle, but it can also mean things like earnings cycle, or issuance cycles for debt, or supply and demand cycles for commodities. But it's really bringing in that extra lens to help round out the valuation view. And it also, of course, includes the vitally important area of monetary policy, which is something we're going to have a look at a little bit later in the presentation. The other thing is then moving on to tactics, which to me encompasses a whole range of indicators, such as traditional technical analysis kind of inputs, and try to prefer to stick to the sort of more sensible areas of that, the areas where you can be a little bit more disciplined. It's hard to avoid having some judgment, but you have where you can reduce the levels of judgment is good. And then also bring in factors such as sentiment, flows, and positioning. I mean, really what the point of this last phase of the research process is to fully round out what insights you've been able to generate from the previous two steps. And it can sometimes go in reverse too, because if some sort of market is breaking out on a technical front, then it might pay to actually go to use that as the starting point, and then come back to the fundamental picture to just round it up. So how to think about investment risk. The reason why I went for the process here is because it's quite useful when you think about risk. So first of all, traditionally a lot of people think volatility equals risk. I don't think so. Actually, oftentimes higher volatility results in better opportunity rather than better risk, and sometimes actually lower volatility can be risky. So my perception of risk is that it's owning an asset which is overvalued, over-owned, overbought, and out of time. And you can kind of see how that ties into what we just talked about on the process. So if an investment's overvalued, if it's over-owned, so people are very long, it's a crowded trade. If it's overbought, that's just a technical definition, really, technical analysis method. And out of time, it comes down to the cycle and the monetary policy backdrop. But risk is also missing out on assets which are at the opposite end of the scale, which is undervalued, unloved, oversold, and turning around. And it's the other point that I got here. It's very important to see things as they are, so to be very chart focused, very data driven, and and also to avoid forecasting, but particularly so on seeing things as they are. Not getting caught up in the news or the noise, and not getting caught up in your own biases, which is a pretty big risk. We talk about risk, that's a big risk. And it's also critical to, frame the key risks, define the key risks, and what drivers or indicators should be watching to try and get ahead of those, and ultimately try and put the odds in favor. And pretty much that's what I'm doing here, like every day of the week, every week and month of the year, is trying to put the odds in favor of my clients by giving them, these research insights. And speaking of which, let's get straight into it. Global Economic Risk Radar. So the first one here, we've got a look at really what's defining where we're at in the cycle, in my view. So one on the left shows economic confidence as composite measures across various indicators. We've got the indicator for America, Eurozone, Japan. And then on the right, we've got this interesting schematic showing basically labour market capacity in the blue and industrial capacity in the black. And really the picture there is that capacity is tightening up, and on the left, developed economies looking pretty strong. And typically the next step from this kind of setup is higher inflation. And what do you get when inflation is higher? Central banks that are having a inflation fighting mandate, they're going to be doing less easing, normalizing policy, and going full circle, tightening. So the chart on the left there is one that you might have seen, but it's basically showing the year-on-year change in balance sheets for these three key central banks. You can see that the Fed there has already moved into tightening mode, quantitative tightening, so it's reducing the size of its balance sheet. And you can see also that the ECB and BOJ are heading in that direction. So the BOJ have entered into stealth tapering. They didn't tell us that they were going to taper, but they have. So it's a pretty key piece of information to have there. Same thing if you look on the right. So the black line there is the shadow rate. So that incorporates the impact of quantitative easing on the policy rate, gives you kind of an effective rate or a real rate. So you can see there that it was substantially negative compared to a still positive headline policy rate. Big thing to look at or talk about there is number one, in 2016, big easing if you look at the shadow rate, and that helped cement that big global synchronized recovery that we saw, helped empower the new bull market, and now things have come full circle. So this is, if you want to think about risks, this is probably one of the key areas here. I still think that monetary policy is something to be mindful of at this point, but not quite something to be fearful of as such. But we're headed in that direction. Moving on to the next slide, this one is showing you the picture for emerging markets. So on the left hand, we've got here in the red line is the composite view of monetary policy rates across emerging markets, and you can see there that they've been very busy easing, cutting rates, so doing the opposite of what our developed markets have been doing actually, and that's helped cement the case for EM equities actually also in the EM cycle there. But it's a little bit nuanced, because if you look at the one on the right there, that's the China stimulus indicators, and that's gone from very tight in 2015, which almost pushed China into recession at that point. Then when that turned around, that was a big game changer, and certainly at that point we were becoming quite bullish on particularly commodities, which had a very good run, but broader growth assets, because it's pretty much a game changer when they make such a decisive turnaround in monetary conditions and the fiscal impulse. But now we've moved from tailwind to slight headwind, and that is going to be probably, if the previous chart was problematic, this one is going to be even more so, and that's going to create, in my view, a bit of headwinds for commodities. In particular, you also look at the property market for China, and that's looks to be rolling over. Leading indicator says even more of a slowdown. And likewise, you look at the PMI and copper price. Both of those look to roll over. So this is definitely an area that's front of mind for me. And aside from traditional cycle, because what we just talked about there was really it's not really anything new as such, because it's just the normal progression of the business cycle. In the early stages, the banks cut rates, bolster the economy, get things back on track. And then you have that mid-cycle period, that sort of sweet spot, and then you move into the last spot, which is where the central bank goes back into tightening mode, inflation picks up, markets in general become a little bit more volatile at that stage. But the other risks that I'm putting on the economic side of things is sort of geopolitical or political, and oftentimes actually you find that political risk is very much sensitive and driven by economic risk, or economic outcomes actually. But anyway, the point of these two charts, number one, you can see there is the Global Economic Policy Uncertainty Index against the global VIX, and that's just saying that policy uncertainty is still very much elevated across the globe, and that gap that had persisted, which part of the reason for that gap was all that policy easing that central banks were able to suppress that, because we had this good economics times, good market times going on in the background. And as I said, when you get into the later part of the cycle, things tend to get more volatile. One on the right is kind of interesting. It shows US dollar implied volatility against US policy uncertainty index, and I think it's fair to say that political risk for America is definitely more elevated than usual. It's a little bit more difficult to manage political risk. It's more straightforward to manage business cycle risk, because a lot of the key aspects of that can be seen in advance. So it's pretty straightforward to track leading indicators of the business cycle. A little bit less straightforward to track political risk indicators, or try and get ahead of that. So probably the only thing to do there is to talk about cash weightings, which we'll talk about in a minute. Just to sum up, developed economies, late cycle, inflation's rising, monetary policy experiments coming full circle, that's the key risk there. China and emerging markets are still recovering, still in easing mode, but China is turned from stimulus tailwinds to headwinds, and so EM looks good, but China risks skew the outlook there, make it a bit of a wild card. Political risk, very real, mostly headline risk though, as opposed to business cycle risk, or more fundamental or more enduring risk. But very real risks and material, and hard to predict or hedge by their nature. Moving into the asset class section. Now these two charts are a bit of an old favorite by now actually, and the one on the left is showing you valuations for treasuries, the S&P 500 and property. And you can see there that they're all in the expensive zone. Now it's a different environment to what we saw in the late 90s, where stocks were in a bubble, and then in the mid 2000s where property was in a bubble. You could possibly argue that bonds were in a micro bubble, in some of the recent years, just pushed into that space by central bank buying. But the bottom line is that we're in this pretty rare scenario where all of the major assets are overvalued. Now, commodities are still on the cheap side, but I don't think that now is necessarily the time tactically to be hiding in commodities. Well, I don't know if that you can actually hide in commodities with from this sort of valuation backdrop. But anyway, looking at the one at its companion chart, the one that shows cash allocations for the American Association of Individual Investors survey and the implied allocations to, which is money market funds as a percentage of total mutual fund assets under management. And you can see there that, whether you want to call that a cycle low, it's very close to a record low on the AAII and at a record low for the implied allocations. Bottom line is that people look fairly fully invested on this this particular lens. Now, yeah, they can get more fully invested because it's still at about 15%. But one little interesting comment that I made about these two charts is that the contrarian minded would be very interested because, clearly people are under on cash and over on everything else. The central banks have bullied investors out of cash by making it unattractive and pushed them to get into other investments, and this is what you get. You get overvalued assets across the spectrum. Now, one other area that I really want to spend a little bit of time on is what have traditionally been thought of as the major hedging assets. So if you think about bonds and gold, most people think of them as risk hedges, and certainly if we got a sudden risk off or recessionary type of conditions, bonds would probably do well in that situation. So, and probably gold would do okay in that sort of scenario as well. But if we don't get that, there's a number of monetary and macro headwinds facing gold and bonds. So bond yields are biased to the upside over the medium term. If you look at this chart, it shows you the longer term GDP growth rate against US 10-year treasuries. And yeah, the bottom is in, and the bottom is in because the economic fundamentals justify that. But it's still a range trade for bonds, and we're in the middle of a pullback at the moment. Could take a couple of more months before the recent shift in sentiment gets washed out and the economic picture becomes clearer still, because there's been a little bit of doubt placed on that for some people. And the one on the right shows you the Krippner shadow Fed funds rate. Again, that's a Fed funds rate adjusted for the impact of quantitative easing. So if you think back to 2011, 2012, the shadow rate was deeply negative versus zero as the headline rate. Now, basically, if you look at this chart, it says, if quantitative easing was a tailwind for gold, now it should probably be a headwind. If you also think about where real yields have gone, gold facing another headwind there. Longer term, valuation proxy, gold and real price is more than a standard deviation above its long-term average and is looking very stretched against other commodities. So, this provides a bit of a bearish setup for gold, and also, it's kind of broken out of its downtrend channel, but it was quite a weak and undecisive breakout. And that overhead resistance of 1375 has been pretty immutable so far. So, that's why my view is, yes, maybe gold does work as a hedge in a down market, in a recession. Same thing for bonds. But do they perform in an up market, or if things just carry on ticking along like they are? Then they're not going to be hedges, they're going to be sources of risk. So that's one to be mindful of. Now moving on to the stock market, probably one area of a lot of interest for a lot of people. Now if you look back at the turn of the year, leverage was very high, sentiment was extreme, valuations were pretty high, positioning was very much along, cash allocations, as we saw, were very low. So it was a market that was certainly receptive to bad news, and we got the bad news and we got a correction, and we've seen at least a partial reset of some of these things. So valuation's more neutral now, sentiment has come back, leverage has come back a little bit as well, and basically, you know, the way I'm looking at this, or the thing that I'm focused on really, is this next chart, next set of charts. And let's rewind for a second back to the 2015-16 corrections. What did we see at that time? We saw the economic indicators weakening. We saw global trade almost into recession. Saw earnings contracting. And it's important to keep that in mind, because actually if you look at it now, what we're seeing is that earnings are accelerating. Global macro backdrop is pretty good. You know, nothing to complain about there. If it was, you know, if we'd had the same backdrop from 2015-16 as we did, you know, if we took that picture and put it on the current environment, then it would be a bearish picture, very bearish. But my view is that, you know, you look at these and you err on the side of optimism. You know, monetary policy, again, is something to be mindful of, but not yet to be fearful. So my view is that, you know, again, aligning up with the business cycle, and markets and the business cycle tend to, you know, walk a similar path, is that, you know, we're late cycle, we're about squeezing that last part out of the cycle. Now, just a quick thought on credit markets. So, I mean, there has been a couple of sort of orange warning lights come up for US high yield credit spreads, and, you know, a little bit of angst in some of these other indicators like the TED spread. Again, it's the same picture, or the same scenario, where yes, the orange lights are there, but the red lights are yet to show up. For credit, what I'm watching is lending standards, a tightening of lending standards, deterioration in the credit managers index, or a rolling over in the economic conditions, and we haven't seen any of those yet. So those are the ones that are going to be pretty focused on to get the risk scenario there. So just to sum up there, for equities, still erring on the side of optimism, vigilant to the risks, seeking but not hiding in relative value. And it's another point that, you know, there's still pockets of relative value out there. And on fixed income and commodities, you know, when push comes to shove, bonds and gold probably will still work as a hedge, but these are not risk-free, and that's the bottom line there. And cash kind of looks like a contrarian opportunity, but again, you know, this squeezing the last part out of the cycle, it kind of sounds like it may only be a small part, but, you know, it could actually still be quite substantial. And, you know, some people are quite willing to just, you know, have more certainty of capital and be okay with missing out. Others, you know, they have objectives to meet, and, you know, missing out on that last phase could be quite costly for some. But anyway, this is just a bit of a summary of where we're seeing the risks, opportunities across the major asset classes, and again, as I said, about the economic front as well. So, you know, just getting engaged with things there, and does look late cycle, monetary policy tightening. And then, you know, back up, we talked about the risk, how to think about risk within a wider investment process or research process. And so I think you know, it's a pretty interesting view overall. Hopefully you found it useful and interesting. Disclaimer there, just for completeness. And if you want to follow what we're doing, go to topdowncharts.com, or you can find us on LinkedIn, Twitter, or YouTube. Just search for Top Down Charts. And other than that, be sure to follow the YouTube channel so that you don't miss out on any future updates.